You had your best sales month of the year and you've got less money in the bank than you did when the month started. And your profit and loss statement actually says you made money. All three things can actually be true at the same time. It's not a contradiction. It doesn't mean that your bookkeeping is broken. Usually the problem is inventory. And inventory is the one thing in your books that behaves different than most anything else. And no one really explains it well. So it just makes you feel like you're bad at business. Here's what this ends up looking like. It might be August and you know that you've got a reader event coming up. You have the holiday sales coming up, so you do the responsible thing, you want to get ahead of it, and you make an inventory order. And it feels great because honestly, you're planning ahead, the boxes show up, the house smells like a bookstore, it's a good day. But then a little bit later, we look at our bank account and there's nothing in it. And we might not connect the two things because maybe we bought the books on a credit card and we just paid it off and other things happen. And so we think maybe something went wrong in August. Maybe my ROAS was low. Maybe I spent too much money. Maybe the royalties didn't come through. So you start questioning yourself, but it's not that anything went wrong. You didn't lose money necessarily. You turned cash into books. The issue is that you can't take books to the bank to pay your mortgage. So I want to show you how to handle inventory in your author business so that your numbers actually tell you what's happening. And we're going to use spreadsheets. And then at the end, I want to talk about tax side of this because there's a piece of advice that goes around about deducting inventory that I really want to deal with because it's important that you get this right. Let's jump in. Step one is going to be to separate what you bought from what you sold. Step two is going to be figure out your real cost per book. And then step three, we're going to fund the next print run before you need it. So I know that these don't really mean much on their own. Let me just walk you through it real quick. So step one is really where the mistake happens. And we have to separate what we bought from what we actually sold. I love a good analogy. So think of it like this. If you go to the grocery store and you spend $300 on groceries, you didn't eat $300 of groceries. You took those groceries and you put them in your pantry. You end up using the groceries in the pantry the next couple of weeks. So somebody asks you, hey, what did dinner cost last night? You're not going to say $300. You're going to take whatever you think the cost was of the ingredients you used, and that's the cost of your meal, even though the cash is already gone. So you have to start thinking of your print run as your pantry. The books that you bought are in the pantry waiting to be used. So let's put some real numbers to this. I'm going to open a new tab, zoom in so you can see it. We're going to say title, then number of copies in, then costs per book. And let's just start with that. Let's just say for book one, we bought 500 copies and the printer charges us $4.20 per book. So that means the print cost is going to be the number of books times the cost per book. That part's easy, $2,100. But then they also charged you freight. So let's say to get the books from your house to your house, it's going to be $180. So the total cost for you is going to be the sum of this plus this of $22.80, but we want to know the per book cost. So we want to take that basically shipping cost and spread it out over the 500 copies. So now we're going to say let's say the total per book, and we're going to just take that total of $22.80 divided by 500. So each book cost us to get to us $4.56. So this is getting our cost per book. Now we're going to do the sales side of things. Let's say we're going to have some more columns here. We're going to have the title, we're going to have the number of copies sold, and we're going to have the sales price. And so we got book one. Let's say, I can't type, let's say we sold 60 copies off your own website for $22 each. So your total revenue for that is going to be the 60 copies sold times $22. So you made $1,320. Now there's two ways to do this. So one way is to expense the books as you buy them. This is usually what people do. If you've got your bank connected to QuickBooks, QuickBooks is bringing in these transactions and you see the money leave the bank, and so you call it an expense. So version one of this, version one would be revenue is the $1,320, and expenses for inventory is going to be the $22.80. And so our net profit or loss, put that in the parentheses here, let's just make this a little bit bigger, is going to be a negative $960. So on paper, it looks like we lost $1,000. And cash flow wise, you did. You spent $22.80, but you brought in $1,320. But that doesn't mean that your business is failing. It just means that you have an asset, a literal asset that you could use to make more money. So version 2 of this would look like this. Let's do version 2. And this is like the 100% correct accounting way to do it. And before I go to version 2, I just want to do a couple of changes up here. So realistically, whenever we talk about what we sold, we call this cost of goods sold or purchases. So let's just say cost, let's do purchases. And this would be really we call this gross margin, because this is actually before any other expenses. You might have ad spend, you might have supplies, you might have subscriptions. Can't type, subscriptions, let's just say subs. And then after all that, you have your net income, right? So we're starting off, let me put some lines here to make it pretty. And we're gonna have total expenses, and this is gonna be the sum of these things. And then you have net income, and your net income is gonna be your gross margin minus your expenses. So let's make this a line. Let's make this this. And we're gonna put some numbers here. Let's say that we spent $250 on ads. Let's say we had, $100 of supplies, and we've got $200 of subscriptions every month. So it looks worse and worse and worse the further you go with this, because we started off with not even enough money to cover the purchases we made, much less our overhead. So let's add a row here, make it a little bit prettier. One more here. Sorry, I'm kind of a stickler for this. And now we're going to move this version 2 up here so we can see them side by side. Before I get into that, let me make these numbers so that it looks even prettier than it does now, but I don't care about the pennies. So in version 2, we actually don't care about the purchases. We're not going to call it purchases. Instead, I want to call this, I won't be able to do it that way. I'm going to call this cost of goods sold. All right, whoops, I screwed that up. Okay, so we still had the same amount of revenue. So we still had this revenue, but instead of subtracting the entire amount that we spent on books that month, we're only gonna subtract the cost of the books we sold. So we're gonna take the 60 books that we sold times the actual total cost per book of $4.56, and we get a number here that we need to make a negative. So we actually have a gross margin of $1,046. If you look at it, now we can start doing percentages, and we can see that we get to keep 79% of everything we sell. We have a 79% margin. I did another video about margin recently. I'm gonna put the link wherever it is showing up on here. Okay, so now let's take our ad spend and everything else and take these whole thing, go down. Now we actually have a profit. So now we have a profit margin of, we're going to call it 0. We're going to call it 38. I'm going to move this version 1 here so that it makes sense. So here's the thing. Version 1 gives you the true picture of your cash flow. You really did spend $1,500 more cash than you brought in. Maybe you had debt, maybe you had a credit card, maybe you had to put personal money into the business. And so version 1 is helpful if what you're trying to do is to find out like how much money came in and came out of the business. Version 2, though, actually gives you the true health of the business, because now you know that you have all these other assets, all these other books sitting over on your balance sheet available to spend, available to sell. So the thing that's making you feel crazy about this, if you have your accounting being done the right way, full accrual, full inventory, then your bank account did decrease $1,500, but you're showing a profit of $500. So how does that make sense? Especially whenever it comes time for taxes. The difference between these two numbers is still sitting in those boxes in your living room full of books. So now that we know how to make this work, how do we make sure that we have enough money set aside the next time we need to make an inventory order? What we're gonna do is we're gonna figure out what percentage of our sales is inventory. So this is really easy. We already know how much it cost us per book, and we already know what we sell each book for. So we're gonna just take our cost divided by the sales price. We get about 21%. What we're gonna do is we're gonna take 20 to 21% of every single sale we make of this book, and we're gonna put that into a separate bank account called inventory. You'll know that we like the profit first system here, where we use bank accounts to separate money that we don't wanna spend on other things. So we're gonna take 21% of each sale to put it into another bank account. Now, what if you have more than one book? What if you have book 2, book 3, and the numbers are slightly different? Then I don't think you should take, the margin from each individual book and calculate it separately every time you sell something. I would just do an overall. So if you've got book 1, 2, and 3, and the overall cost of goods sold on that, or the overall cost margin on that is 25%, then just take 25% of every sale, regardless of what you actually sold in that sale. Also, you know that the next time you order books, it's not going to come out to exactly $4.56. It might be a little bit different for the printing cost. It might be different for the shipping cost. And so if you want to have a little bit of a buffer there, you might change this to 22% or even 25%. If you can't do that though and still operate your business, and that's okay, just do the 20% because at least you have most of what you need. After you separate out that 20%, you're left with the money that you can use to operate your business. And if you pay attention, this version 2 is exactly that. We're taking 1320, we're subtracting the cost, which this is going to be about 20%, 21% of that. Let's make it a percentage to show you. And then we're left with 1,046, which was the difference to cover our overhead. So by setting up this other bank account, you actually kind of solve the gap between this version 1 and version 2, because here's the issue. Doing version 2 is complicated for accounting. To go in and figure out like what the cost was of the books that you sold, you either have to go in and figure out every book you sold in a time period and make an adjusting entry, or every month you have to go and recount all your inventory to adjust your inventory in your bookkeeping to what it is, and then plug that difference through cost of goods sold. If it sounds complicated, it is complicated. So even though this gives you a better picture of your P&L of how much money you actually made or lost, it's more complicated to do it. So instead, if you just let your bookkeeping track the actual money in and the actual money out in version 1, where it looks like we had a loss, but you set aside money for those books whenever you sell them, then your bank account is going to reflect the actual money that you have available to run your business, while your bookkeeping reflects your profit, your actual cash inflow and outflow. Now let's jump out and talk about the tax side of this and why this is important. For tax purposes, inventory could be a big trap because the IRS says by default, you're not supposed to deduct the inventory that you purchased until you sell it. So what that means is if in November or December you spent $20,000 on inventory, but say you've only sold $1,000 or $2,000 of that inventory, you only get to deduct the $1,000 or $2,000 that you sold. So you're out the cash for the full 20, but you don't get the tax deduction for that until much later. That could be a huge issue where you end up owing taxes on money that you don't have. But if you're a small business, and in the IRS's eyes, you're a small business, if you're making less than millions and millions of dollars, then the IRS allows you to deduct your inventory in the way that matches your books and records. In other words, if for bookkeeping purposes, you're tracking your inventory and the amount that you've actually sold, then the IRS is going to expect you to pay taxes that way. But if in your bookkeeping, you're just expensing all your inventory as you're purchasing it, and you don't have a way in your bookkeeping to show the amount of inventory on hand, then the IRS allows you to deduct it that way. So if for bookkeeping purposes, you're tracking your inventory purchases as an expense and you're not tracking the actual amount of inventory on hand, then you get to get the deduction for that whenever you pay for it. And then if you're setting aside your money for inventory into that inventory account like we talked about, now you also have a bank account that shows you how much money you actually have to run your business. So you kind of get the best of both. Inventory management and margins is such a big opportunity to save money and increase cash flow, but there's also a lot of ways to get it wrong. So it's important to look at your specific situation. And if you want me to look at your specific situation, check out the link in the description to our author community. We do regular calls there where I can look at your stuff specifically and let you know what I think about whether or not you should be doing version 1 or 2 and the tax implications of both. I hope that this was helpful, and I will see you next time.